Greetings. My name's Laura McCabe, and I'm the Director of Marketing for Sal Management. I also serve as the producer for our Trailhead Thursday webinar, so thank you for meeting us at the Trailhead. I'm going to handle a few housekeeping items, and then I'm going to hand the program over to our host, Scott Dooley, who is the Managing Director of Investment Management at Sal as well. Today's webinar will be recorded. That recording will be available on demand using your registration link, but we will also send out the link in a separate correspondence that comes from the platform itself. So look for that to come from Zoom tomorrow sometime. And then I also wanted to talk to you about questions and answers. We will, after Bryce Gill's presentation, we'll have a segment for questions and answers. I encourage people to go ahead and put questions in whenever they come up, and Scott Dooley will be our monitor, and he will be taking control of that. So the chat is reserved for the panelists and the host. So please use the Q&A window only. You also have the option of raising your hand. There's a little hand button down at the bottom, and I can give you the mic so you can ask your question live as well. So with all that, I'll pass it on to Scott. Scott, mic
thanks,
to
Laura.
you. You're welcome.
All right. Hi, everybody. Thanks so much for joining us today. We're very excited, to welcome you to today's discussion on reshoring, reindustrialization, and the Trump economy. With so much going on in the world, everything from tariffs and trade policy, and kind of new headlines coming out almost seemingly every day now. There's been a lot of volatility in the U.S. stock market and a decline, which in the last couple of days, have been a nice rebound. We feel this is a very timely and important conversation to hear what's really going on in the economy from an expert. But before we dive in, I would like just to extend a special welcome to the guests, some of our advisor partners. I know both John DeShaw with Solera and Josh Morales with Nest have some clients that have joined. Thank you, so much for taking some time today to talk with us. We're very glad to have you here. With that, and just to help us cut through the noise and focus on what really matters to your portfolios and investments, I'm pleased to introduce our featured speaker, Bryce Gill. He's an economist, and he's part of the First Trust economics team that Bloomberg has ranked as one of the top forecasters of the U.S. economy over the past several years. First Trust is a firm that Sal has partnered closely with over the years. They offer some great investment products, including ETFs, buffered strategies, and alternative investments. And some of the best content and actually best attended webinars that we've had over the last few years have been with Bryce. So we're very thankful with him. Bryce brings a very sharp, data-driven perspective on the economy, along with a focus on connecting macroeconomic trends to what's relevant to your investment portfolios. And then today he's going to be unpacking what's going on with tariffs, talk a bit about inflation, the Federal Reserve, and where the economy might be headed next. So with that, again, we'll close with some Q&A. So feel free, again, as Laura described, to put your questions in the Q&A box, and we'll make sure we get those towards the end of the presentation. And with that, I'll turn it over to you, Bryce.
Okay. Well, thank you, Scott, so much for the introduction. Thank you, Laura. Thank you, Sol, for having me. It's great to be with everybody on the call today. And obviously a great time to do it because things have been a little bit chaotic with the stock market, okay? And so we came into 2025 basically at a record high. Donald Trump comes along, right? He puts the tariffs in place. The tariffs have gotten a lot of the blame for what happened next, but the stock market had about a 20% correction, okay? So generally speaking, guys, 20% is pretty big, but it's not something that's statistically very unlikely either. If you go back through the past 100 years or so in the U.S. stock market, you get a 5% correction in stocks probably, every 8 months or so. You get about a 10% correction every 14, 15 months or so. And then you get a 20% plus correction, which we officially would call like a bear market, about once every 2 years. So Generally speaking, guys, it's been a couple really good years in the stock market, 20+% returns. Famously, like 7 stocks have kind of driven everything. The past couple of years, the market was looking a little bit frothy in valuation. There were some reasons for concern around the stock market. And my personal opinion is I think we were sort of priced to perfection. And hey, Donald Trump came in with the wrecking ball of uncertainty, right? Mostly we're all expecting tariffs, but these were bigger and sort of broader than people generally expected to happen. And so the result is, hey, that price to perfection situation in the stock market could no longer hold, and we ended up getting a correction that, in my opinion, was kind of overdue. So overall, guys, it looks like we bottomed. Looks like the market's bounced back pretty significantly. But heading into this year, I think the market was overvalued. Okay, and the way I get there is not because of how I feel about Donald Trump, or it's not because I don't believe in AI or automation, or it's not because I thought the U.S. economy is going to have like a big recession or a bunch of problems this year. And I'll walk through all the kind of details on tariffs and the economic impact we're likely to see. At First Trust, we just try to use math to cut through the noise, right? And when you really look at it, the markets over time are driven by 2 things. They're driven by profits and interest rates. And to be honest, profits look pretty good. I'm not that worried about profits this year. What made us concerned about the stock market was interest rates. As a firm, we've been bullish on the U.S. stock market for about 15 years. And it was really after the COVID inflation hit and the Federal Reserve hiked interest rates that the stock market started to look a little bit frothier in valuation, right? So it's these high interest rates that, I think were the catalyst really at the end of the day for this market sell-off. Tariffs obviously added uncertainty and got rid of that perfect scenario, like Goldilocks scenario in a lot of people's heads. But generally, I think it's higher interest rates that have kind of caused the market to hit some headwinds here. So with that, what I'm going to do is I'm going to share some slides. We'll talk about why interest rates are high. We'll talk about the impact that tariffs are likely to have. We'll wrap it up with some quick thoughts on like the government budget situation. And then I want to turn it over to Q&A so we have plenty of time to hear from everybody in the audience about what's important to you. So with that, I'm going to go ahead and share some slides. Scott, just if you could give me a verbal confirmation this stuff shows up on your end. I don't want to be running through without the audience being able to see it.
Yes, I can see it.
Okay, perfect. Thank you so much, Scott. Okay, guys, let's start with interest rates really quick. And let me tell you why I think interest rates are high. And they sort of fall a little bit, they bounce back up. That's kind of what's happened recently. Generally speaking, though, they're much higher than they were pre-pandemic. And I think they're going to remain high for a couple of reasons. Okay, I don't think we're going to see a big decline in interest rates here. And the 2 reasons are, one, inflation just remains above the Fed's target of 2%. So the Federal Reserve can't really come in and cut rates and save the day here. They sort of started trying to do that last year, and then they ran into headwinds. They've had to pause their rate cuts. And obviously, Donald Trump's famously been talking about maybe firing Jerome Powell because Powell won't cut rates, right? Well, the main reason why is just inflation's still too high. And the other thing I think is going on with interest rates is just, hey, the government budget situation looks pretty unsustainable today. It was fine at 0% interest rates, but if you have 33 trillion in debt, you're running a huge deficit, and interest rates are way higher too. Well, that budget becomes unsustainable. And then as investors, we look at it and say, well, if I'm going to lend to U.S. government for 10 years, like I want to be compensated for that risk, right? So the combination of high interest rates or high inflation and an unsustainable government budget, I think is keeping interest rates high in the United States. And so I want to talk about inflation first, okay, because it ties in really well with the whole reshoring tariff situation, okay? And it gives me the ability to lay the groundwork for like the bigger picture of what's kind of been going on, because the reality is tariffs from Donald Trump, first of all, they did them in his first term in office. They might not have been this big, right? But big changes in trade policy and supply chains, that's not a new phenomenon. That's been happening in a pretty dramatic fashion since the COVID-19 pandemic, okay? And so the chart on the screen, what I have here for you guys is just data on manufacturing construction in the United States. So this chart just shows how many factories we're building in the US, okay? And basically what you see here is the past 30 years pre-COVID, factory construction was at a crawl. There was really no progress. There was no increase in manufacturing investment in the United States. Well, very quickly, manufacturing construction in the US has tripled in the past like couple of years here, okay? And so I like to tell people that the past 30 years has been the biggest boom in globalization in modern history. Essentially, the Soviet Union collapsed, China joined the WTO, we united North America with NAFTA, the biggest free trade agreement in the world at the time. And so, bottom line is we just got access to a lot of cheap labor and materials in the United States in a really short period of time. And so, if you can outsource your factory to China and cut your labor costs by 90%, it's going to be really good for your profits, obviously, as a company. It's also going to be really good for domestic inflation in the United States because you can pass on those cost savings from cheaper labor to the end consumer, right? And so I think one of the reasons why we've had this 2% inflation rate in the US the past 30 plus years, why that's sort of normal in people's heads, is this giant boom in globalization. It's access to all this cheap labor, right? Well, the downside to all that, or like the trade-off to all of it, right, is that you're going to deindustrialize as a country, and hey, supply chains are going to get really long and complex. They're going to be more efficient. There's no question about that, right? But they're also going to be fragile as well. And so something like COVID-19 comes along, it totally upends the apple cart, changes everybody's mind, and we basically see a huge political push to build some resiliency into supply chains. And that, it's inevitable that this is going to happen, in my opinion, because we just had the worst supply chain crisis since the OPEC oil embargo, right? And so post-COVID, maybe this starts out with Donald Trump, right? He's talking about this stuff in 2016. COVID makes it bipartisan, though. It's one of the most bipartisan issues out there today, reshoring. And so he passed the CHIPS Act, the Inflation Reduction Act. That's when factory construction really starts to take off in the US. Part of it's that legislation. Part of it's just a response to, again, the worst supply chain crisis since OPEC oil embargo. And so it does look like to me, guys, this is the biggest factory construction boom since World War II, probably in the US. It does look to me, guys, like we're becoming more self-sufficient, like we're going to produce more things in these critical industries for ourselves. But the trade-off is, hey, if 30 years of cheap labor made inflation 2%, reshoring and paying Americans to do all this stuff is going to add some cost, right? It's going to be a little bit more expensive. And so my opinion is reshoring, bringing all these jobs back home, baseline inflation is not 2% anymore in the United States. I think 3% is maybe more normal now. And it's going to be hard for the Fed to get to their 2% target and keep inflation there. And so I think, hey, the Fed's going to have trouble coming to the rescue because inflation is going to stay consistently above that 2% target because of huge changes in global supply chains. All right. Now that's a good transition into the tariff section. Okay. I mentioned that I think reshoring is a very bipartisan issue, and I think the polling bears that out. Now, when you look at it, though, the two political parties have kind of a different way they want to go about it. The Democrats favor industrial policy, the CHIPS Act, the Inflation Reduction Act, and the Republicans kind of favor, I guess what you'd call tariffs instead, right? And industrial policy works great. It's helped the factory construction boom unfold in the United States. The only problem with industrial policy is it's really expensive. It costs about $3 trillion for those two pieces of legislation. And as I mentioned, we got a budget problem in the United States that we have to solve, right? And so, hey, tariffs, they're a blunt instrument, right? There's probably a more surgical way you could go about doing things. But the good thing about tariffs is they change incentives around production. And instead of, sending a bunch of money out the door at the US Treasury, you actually collect a bunch more revenue instead. So it continues to change production incentives and incentivize reshoring, but it actually brings more money into the Treasury. So I think that's one of the reasons why you've seen tariffs become, a bigger and more accepted kind of tool to use here. Now, let's talk about what's happened since April 2nd, okay? And the chart I've got here is just 200 years of US tariff history. I wish I had time to go through like the whole history, the whole story that this chart shows, because it's pretty interesting. But you see how tariff rates have fallen significantly over time. And especially in like the late 1800s, tariff rates start really going down. And post World War II, they stay low for like 80 years, right? Up until April 2nd. So that last little line there, that last little blip in the data, that's Liberation Day, right? That you can see how much the tariff rate has surged. And so a lot of people today are drawing, are drawing parallels to the 1920s and the lead up to the Great Depression, because objectively, like the average effective tariff rate is as high as it was in the lead up to the Great Depression before Smoot-Hawley, and some people might have heard of that, the Smoot-Hawley tariff. And so back then, hey, global trade fell apart. The U.S. was, we were a giant exporter. We were exporting to the European powers during World War I. We were kind of like Germany or China are today, giant exporting economies. And all of a sudden, hey, our export markets disappear because the war is over and countries want to be more self-sufficient. And so, hey, I think global trade was collapsing. It was bad for us as a giant exporter, and it did help exacerbate the Great Depression situation. Okay. The good news on all this, though, guys, is that things have changed significantly for the U.S. economy since World War II, World War I, the 1920s. Okay, again, back then we were a giant exporting economy. Today, we're not an exporting economy. We're the buying economy. We buy things from the rest of the world. We're a net importer. And even more so than that, we're a consumer spending economy. Okay, 70% of GDP in the United States is consumer spending. And so we're not dependent on making manufactured goods or agricultural products and exporting them to the rest of the world. When you look at like the overall U.S. economic pie anymore, today we talk about self-sufficiency in supply chains, right, all the time. We're worried about semiconductors and Taiwan and everything else. But when you look at the overall U.S. economy, just economic activity wise, we're actually one of the most self-sufficient economies in the world. Most of what we do economic activity wise is domestic in the United States. We're not very dependent on trade. Okay. So I mentioned that consumer spending is about 70% of GDP. When you look at consumer spending in the United States, about 70% of consumer spending is services. Okay. And so what is a service? Service is me getting on a presentation like this and doing, giving you like some economic history, right? Or Laura and Scott giving financial advice, or, going out to eat or getting a haircut or going on an airplane, right? Services, by and large, are provided by Americans to other Americans domestically and locally. They're not really affected by tariffs, right? And so a huge chunk of US GDP is completely insulated from this. It's not really affected by trade at all. The other 30% of consumer spending is goods. Okay, it's goods imports, but only a third of those goods imports are actually are goods. Only a third of goods are imported goods. Okay, so when you really drill down into it, only 10% of consumer spending in the United States is actually imports of goods. Okay, so it's a pretty small chunk of the overall economy that can be affected by tariffs, right? Now, you kind of dig even deeper into it, okay, and you look at where imports come from. And so what I have on this chart is just imports from Canada and Mexico and imports from China. A huge chunk of US imports today is actually duty-free. They're not being tariffed at all. And I don't think most people know this. And that's the imports that are here in North America. So the ones that come from Canada and Mexico. And we've all heard about the 25% tariffs on Canada and Mexico. And there's certain categories that there are tariffs on today, right? Like steel and aluminum, for example, or like auto parts, as we sort of negotiate around the auto industry in North America. But by and large, about 85% of the trade that's going on in North America today between US, Canada, and Mexico is duty-free. It's not being tariffed at all, okay? And the reason why is we have something called the USMCA agreement. And this is NAFTA 2.0, basically. Okay, and what USMCA says is that if products meet USMCA classifications, meaning they have a certain threshold of inputs that come from North America, then they get to enter the United States duty-free. Okay, so I'll give you some examples, all right? If you go to Whole Foods and you go to buy like an avocado from Mexico, that's not being tariffed at all today. Same for like, Prince Edward Island in Canada. They have some of the best oysters in the world, right? If you're importing oysters from Prince Edward Island, those aren't getting tariffed at all, right? Similarly, like if Mexico produces a soccer ball and imports it to the United States, and that soccer ball is made with leather from Mexico, and somebody in Mexico stitches it, that soccer ball enters the United States tariff-free. It's not being tariffed at all. Okay, what would be tariffed coming from Mexico is something that has a significant amount of content that comes from outside of North America. So say China ships in a bunch of synthetic fabric, and then Mexico turns it into curtains or blinds for your windows, and then they import that. That would then be tariffed at 25% because a significant amount of the content comes from outside of North America. So I think most people don't know most of trade in North America is actually exempt from tariffs. About 85% of it's not being tariffed at all today. So that removes another like 2 or 3% of consumer spending being touched by tariffs. Really, guys, what we're concerned about is China, right? They're the ones with 150% tariff rate. And we're all wondering what that's going to do to the US economy and how it's going to affect us. Well, if 10% of consumer spending in the United States is imports, and China, as you see on this chart, is only 15% of US imports, that means that 1.5% of US consumer spending is coming from China today. So we're talking about a really small overall portion of the economic pie in the United States that's actually getting hit with those like 150% tariff rates, right? And that was before we exempted iPhones and like electronics and other things. So generally speaking, guys, when you look at the impact that this can actually have on the US economy, when you consider, hey, most of what we do is services, we produce a lot of our own goods for ourselves, and consumer spending is only about 10% imports. And then China, who's the biggest component, biggest tariff rates, they're only 1.5% of consumer spending in the United States. What you'd see is, hey, best estimates say that US GDP, just assuming all these tariffs go in place and stay in place, right? So a worst case scenario where they don't actually negotiate anything, US GDP over the long term is lower by 0.8%, meaning like there's less than a 1% decline in US GDP. And that's an economy that grows 4% a year, right? So this is more of a speed bump to the US economy than it is something that can cause like a major recession when you really dig down into it and see like how small trade is as a share of the overall pie. For also some context, guys, the Great Depression GDP fell by 25%. During COVID, the GDP fell by 10%, right? So guys, I don't think trade or a trade war with China is big enough to cause a recession in the United States. That's sort of my personal opinion. Also, the way they get to that minus 0.8%, this is from the Tax Foundation, by the way, is they say, listen, okay, tariffs are causing all this uncertainty, and companies don't want to invest when they don't know what the actual rate is going to be, and uncertainty is high. So they pull back on investment, they hire less people, wages don't go up as much, right? And GDP is now lower by 0.8%. And I understand how they're getting to that estimate, okay? But all I would say is, given that factory construction has doubled in the past or tripled in the past 2 years, given that reshoring is one of the most bipartisan issues in the United States, given that AI and automation are essentially making factories viable in higher wage countries, just as viable as they are in low wage countries, given that all the cheap labor is going away anyway, China's population's peaked and started to decline, and given that we see a massive amount of like headlines about companies committing investments to the United States to get behind this tariff wall, I am personally skeptical that we're going to see investment decline in 2025. I think we're probably going to see more and more companies try to get behind this tariff wall and build a facility in the United States. So, guys, we're the biggest buyer in the world. Trade is a pretty small part of our overall economy. China's extremely export dependent. They can't export to the United States. They go into a big, massive recession. Whereas, hey, we just have to pay a little bit more for Chinese goods. It's 1.5% of consumer spending. It's a very asymmetric kind of advantage we have in that negotiation, in my opinion. So overall, guys, I don't think tariffs are big enough to cause a recession here. I think they added uncertainty to the stock market that was, probably overvalued and probably priced to perfection. But the tariffs themselves aren't big enough to cause like a significant amount of damage to the real economy, is what I would say. Okay. I guess before I get into Q&A, and I know we're right around time here, I want to touch on the government budget situation really quickly because I mentioned I think that's one of the reasons interest rates are high is just we have this unsustainable budget. Guys, I think one of the best things this administration could do to get interest rates lower is inject some confidence into the Treasury market about the state of the U.S. government budget, meaning they actually need to follow through on cutting some spending, okay? Whether that's DOGE or whatever else, right, or some bipartisan agreement, the debt and the deficit has gotten unsustainable. It's just because interest rates are higher, right? And so COVID spending needs to go away. We need to go back to pre-COVID levels of spending and actually address the spending situation. It's not a revenue problem, it's a spending problem. We collect another $100 billion in revenue and we spend another 300 billion. And so that's just not possible anymore. We actually have to address the spending side of the problem in the United States. I think if they did that, hey, not only does the deficit go down, right, but then you see confidence get injected that the problem's being dealt with, interest rates start to fall as well. That's great for the government debt problem as well, because the interest costs fall, but it's also great for everybody's stocks and bonds because lower interest rates are good for your asset values. So I know I've covered a lot, guys, in a short period of time. I'm happy to expound or get deeper on any of it. Thank you so much for having me and spending some time with me this afternoon, and let's do some Q&A.
Yeah, thanks a lot, Bryce. Yeah, again, for those on the Q&A, you can either raise your hand and we're happy to take a question live, or if you just want to use, if you go under the Q&A function at the bottom of your screen, you can type a question in there. We have had a couple come in already, Bryce. One, and that I think comes up and you've seen it a lot, is just on the US dollar. Is it in trouble? Is it going to remain a reserve currency? And importantly, should clients be concerned about their dollar-based investments? Most clients that are at with our advisors, right, are heavily invested obviously in the US stock market or in fixed income. And how's that maybe come into play?
Yeah, absolutely. And there's been a lot of headlines about the US dollar. I mean, there's been a lot since the invasion of Ukraine, right, specifically, but the past like few weeks especially, the US dollar is like fallen a little bit if you look at like the dollar index internationally. And so I think a lot of people are looking at this short-term movement and saying, oh my gosh, like the US dollar is collapsing or something like that. And I would just tell everybody on the call, think about those headlines and then just type into Google US dollar index and look at like a 10-year history of the US dollar index and see where the US dollar's at. Because the reality is, like the recent movement over the past like week or so or 2 weeks, like it doesn't even register on like the long-term history of the US dollar chart, right? We're still well above where we were pre-COVID. The US dollar makes up over 50% of international transactions. The currency that's really having a reserve currency problem is the euro. You've seen the euro fall in usage significantly. So, guys, I'm not saying like the dollar has no problems, but the reality is there needs to be some rising power that can like take over from the US. It's not Europe, it's not China. It can't be Bitcoin. So, like, who's supposed to replace us? That's sort of the relevant question here. And I think we're reading too much into like short-term movements that really don't register on like a longer term chart at all.
No, great, thanks. Another one, will tariffs cause inflation? You see that a lot in the media is if tariffs go up, well, prices will increase at some level. Like how big of a factor is that, when you look at the actual math of how that would maybe filter through to the US economy?
Yeah, absolutely. So like, I'll answer this two ways. Okay. So one, most of the way the media covers tariffs, okay, is they're gonna like focus on industries that are being hit by tariffs, right? So like famous like the F-150 is going to go up $5,000, or like the National Association of Home Builders talks about, hey, the average price of a home is going to go up $10,000, right? So there's been like a couple of these estimates. And so people see this and they say, hey, it's causing inflation. The price of these things is going up, right? And that's totally understandable. But when we talk about inflation in the United States, what we're usually referring to is the consumer price index. Okay. And so it's a basket of all the things that we buy in the United States. All right. And so as I just like walked everybody through the math, right? Like 10% of consumer spending is imports of any kind. 1.5% of consumer spending is actually directly affected by these giant Chinese tariffs, right? And so even if you agreed that tariffs cause inflation, it's only causing inflation in an extremely small portion of the CPI basket at the end of the day, right? So if it has an effect on inflation, it ends up being very small. Now, my personal opinion on it, okay, is that I don't think tariffs can cause inflation in the United States, meaning a broad-based increase in prices across the CPI basket. And the reason why is inflation is caused by money. It's caused by more and more money being in circulation. That's what happened during COVID, right? We printed $5 trillion and sent checks to everybody to spend. That caused broad-based inflation. Tariffs, if you have a certain amount of money you're going to spend and you're spending more now on like your F-150 that you buy, it just means you have to take money from somewhere else in your budget. And so maybe the price of a new car goes up, but then the price of like haircuts or, you know, restaurant meals or airline tickets or whatever else ends up going down. And on net, the CPI basket doesn't change. So I'm very skeptical that tariffs are going to cause inflation in the United States. I think inflation is just from reshoring. It's from the huge shifts in global supply chains.
Okay. Another one, recent data this morning on existing home sales, right? Which is, at least the headline is, biggest drop since 22.
Yep.
So, where do you see, real estate prices, and how is that affecting, again, the overall outlook?
Yeah, existing home sales have been terrible for like 3 years or 4 years or so. If you look at like the number of transactions, like it's the worst housing bust since 08, 09, right? So, but on top of that, okay, the prices haven't fallen at all, right? And so you've got like this decline in transactions or sales, but no decline in prices. And that's because for existing home sales, nobody wants to list their house, basically, right? If I refinance at 3% during COVID, and now I want to trade up or down and move to a new house, well, I have to get a 6 or 7% mortgage rate to do that, right? So I don't really get anything for my money. So a lot of people are just sort of like stuck in place. They're stuck in the house they own. It's great, right? They've got like a 3% mortgage rate, but it's sort of like golden handcuffs. They're kind of stuck there because financially it doesn't make sense to leave. So it's existing homes have gotten more expensive. It's that there's no inventory of existing homes. That's why you've seen existing homes perform really poorly. New home sales have been a lot better than existing homes. We got new home sales yesterday. I forget what they went up, but they went up like for the third month in a row or something. It's because that's what is making up all the difference. Builders are just building smaller houses. They're offering more incentives. And so, basically if you go buy a house today, like a new home looks more compelling than existing homes in most cases.
Oh, good. So another one on, again, often in the headlines, seemingly at least every couple of days, Elon Musk, some new government spending cut, identifying where they can make cuts. I mean, is the DOGE cuts actually going to have an impact on overall spending? I know you mentioned that earlier in the conversation. How is that maybe playing out when you actually look at the numbers and what's occurring?
Yeah, so I mean, I think we need to cut spending. That's my personal opinion. Okay. Now, are they actually going to do it? That's a different question, right? And I look at like the DOGE tracker, and there's like $150 billion in spending cuts that they found, supposedly, right? And DOGE can't really cut spending, they can just make recommendations. I think they're supposed to make their official recommendations July 4th next year. And then it's up to Congress and the president and OMB to actually execute on that stuff. But okay, it looks to me, and I look at like government spending numbers all the time. We're spending more than we were last year, not like a lot more, but we're spending more than we were last year at the same point, right? So there hasn't been any big cut in spending yet. There are places where you can cut spending, in my opinion. I think you can cut $500 billion of the U.S. budget pretty easily. It just takes a lot of political will to fight this and make it happen. And Donald Trump wants to extend his tax cuts, right? And so to do that, I think he needs to find spending to cut to offset some of that cost. It can't just be expand the deficit and hope the tariff revenue covers it. Because I don't think we're not going to collect enough revenue from tariffs to offset the Trump tax cuts, in my opinion.
Okay, thanks. Another one came in. Can you comment on immigration, and specifically, the understanding is immigration is driving our population growth. So if the government, right, decreases immigration, does that act as a hindrance, to U.S. economic growth going forward?
Yeah, so legal immigration, if you just look at legal immigration, right? So like the 3 million slots a year or whatever get filled. The US population just based on that, and then like natural fertility rate domestically grows through the end of the century. So we actually have pretty good demographics. And yes, like legal immigration supplements that. Illegal immigration over the past couple of years was obviously adding to population growth. We saw like the labor force go up by like 24 million or something in 3 years, right? So that's a lot of illegal immigration, a huge amount. Illegal immigration is down by like 99% today versus like a few months ago. So that's not going to be happening anymore. So it does slow down population growth, but the US population keeps growing with just legal immigration, which I don't think is really controversial. I don't think anybody's against legal immigration necessarily in the United States, as long as it's, done through the proper channels and stuff. So I don't see us having a problem with the population continuing to grow, even with the crackdown at the southern border recently.
Okay, great. Let's see here. Again, we have a few more minutes left. If anyone, wants to, submit a question or raise their hand, again, we're happy to take some more questions. Without, I think one that is often on minds is maybe where do you guys see interest rates with the Fed policy, pressure from Trump on, obviously he can't, directly fire the Fed chairman, but he can clearly talk about it if he wants. But with that narrative, where do you see rates going between now and the end of the year?
Yeah, I mean, so yeah, it looks like he's backed away from firing Jerome Powell. I don't think he should fire Jerome Powell. I don't think there's any reason for the Federal Reserve to cut interest rates, at least right now. Like maybe I'm wrong, guys, and we get a recession from tariffs. I don't think we will, but if that happened, then maybe the Fed has a justification, right? But today, the economy looks pretty good in the United States. There's no reason to cut interest rates. Inflation's still too high. And so, theoretically, you'd expect long-term interest rates to basically be nominal GDP growth plus like, let's say 15 basis points for like a maturity premium. And so nominal GDP growth today is like 4 to 4.5%. So I think you're looking at probably like, let's say 4.1% and like 4.6% on the 10-year is basically what I call normal, and that's where we're at today. So I don't expect interest rates to change dramatically through the end of the year. They'll kind of fluctuate in that band, but I see interest rates as like pretty normal for where the US economy is today. And unless the Fed's stepping in and cutting, there's no reason to expect interest rates to fall significantly.
Oh, great. Thanks for that. Yeah, I think with that, I don't see any further questions. So I think it's a good time to wrap up. So just, first, Bryce, thanks for taking the time to join. We always enjoy having you come and appreciate the relationship, with you and First Trust. Thanks to, all the advisors and clients and everyone who joined the call as well today. There will be a replay available. So, look for an email that, I think will go out tomorrow. That'll be a link. If you have questions, feel free to reach out to me, directly, or anyone on the Sal team or your advisor, and we'll be happy to, route any questions to Bryce and the economics team over at First Trust, and get back to you with an answer. So with that, I'll finish up and have a great rest of the day, everybody.
All right. Thanks, Scott. Have a good one.
Bye.
Thanks, Laura.
You're welcome.
Yeah,
Bye
bye
bye,
all.
guys.